What's up, everybody? Welcome back to Trades and Gains. This is your weekly Outlook report. I'm your host, Max Pitts, and we're going to go over everything you need to know heading into this trading week. Now, last week, the markets took a beating. Like, we're talking a beating. Like, domestic violence should have been called at some point. As inflation data, tariff fears, and the Fed's stance on rate cuts sent stocks into a complete and total tailspin. The S&P 500 fell over 3%. The Nasdaq tumbled. We're not talking fell, but tumbled 3.5%. And the Dow shed over 1,000 points. And as we all know, the Dow Jones Industrial is basically the redheaded stepchild of our big boys in the market. So shocking they got beat down, not really, but it is what it is. You know what I mean? But this week, all eyes are on inflation. We have the CPI report and PPI dropping, which will give us real-time pulse feelings on tariffs that could impact costs across the economy. Because things are about to get expensive. If not, have already gotten expensive. Because if these tariffs do take place, then we can 100% expect some heightened prices in the grocery store. So watch out for that. But on top of that, we have earnings from Oracle and Adobe, which will be in focus for this week. And we're keeping an eye on the options market flows to see where's the big money moving. So let's go ahead and dive straight into it. So what happened last week exactly? The S&P 500 and Nasdaq fell hard as the market reacted to President Trump's fresh tariffs on Canada, Mexico, and China. The Dow Jones lost 1,000 points, wiping out its post-election gains. The Nasdaq officially entered correction territory, down over 10% from its December highs. And inflation concerns surged as oil prices rose on Canadian crude tariffs and import costs spiked across key industries. Fed Jerome Powell also doubled down, saying there's no rush to cut rates at this time, spooking investors even further. Bond yields also plummeted as traders priced in 3 rate cuts for 2025, but the market is still struggling to find its footing. So some of our big stories this week was, one, the CPI and PPI reports. This is our big inflation test, people. Wall Street is laser focused on inflation this week. CPI drops Wednesday, and the market is expecting a 2.9% year over year print, down from the 3% that was printed in January. But if it comes in hot, expect more sell-offs and rate cut delays at that. PPI comes out on Thursday, giving us insight into wholesale costs, a leading indicator for future inflation. If we see a spike, businesses could pass these costs on to consumers later in the year. And mind you, consumer confidence is down right now. So like Target, Costco, Walmart, all these companies who kind of flopped on earnings because of that fact, it is very real. Because you have to understand, like, consumer buying industries are what? Based on consumers. So if discretionary spending on consumers, which would be those shopping trips to Target and Walmart and other retailers, if that is dropping, you can expect those stocks to drop. And if consumer spending is this important aspect of what we're looking at, then it's kind of putting 2 and 2 together at that point. But I digress. Moving on, we have tariff chaos as well. Trump's new 25% tariffs on Canada and Mexico, and the doubling of China tariffs to 20%, because mind you, they were at 10% already, so he threw another 10% on. So that puts us at 20%, are officially in effect. Canada fired back with new tariffs on $107 billion worth of U.S. imports. China responded with 15% duties on U.S. farm goods like pork and beef, but some analysts say they left the door open for negotiation. So this may not be an end-all be-all type of situation. Target and Best Buy, like we just said, both wanted warned about higher costs, and analysts are already slashing profit outlooks for major retailers and manufacturing stocks. Again, like I just said, watch out for consumer-based stocks because they are going to take a hit. Maybe it's time to short them. Who knows? Powell made it clear, however, that the Fed is not in a rush to lower rates, despite economic slowdown concerns. The market is pricing in 3 rate cuts this year. I don't know how. That is not going to happen. I'm sorry. We're not getting 3 rate cuts. So please, I think SPY could see 535 at some point. Just saying. But if inflation runs hot, those expectations will shift fast. And stocks could continue their downward spiral, which, I mean, it's just, if you look at everything in the economy right now, there's really no point in a upward trajectory of any kind right now. So I'm expecting a lot more downside within the market. That's just it. It's just the nature of the beast. It's just part of the game. So put some buy orders at lower price targets because we're definitely going to see some downward spikes before we see upward momentum of any type of rally. But we will be right back so we can go ahead and break down this options market and what the hell is going on. Now we're back to break down some of our options market. Let's go ahead and dive into our flow and dark pool data because that's where the real signals are happening. So first things first, we have some heavy put buying. Hedge funds are bracing for more downside, like I mentioned before. I'm not stupid to this. I promise the info I give you guys is based on me sitting in my office for around 12 to 14 hours a day, just reading news and dark pool levels. Now, the biggest options trades that happened over the last week, we had SPY March 21st puts at the 580 strike with 19 million in premiums. Institutions are betting on further downside in the S&P 500. We also had QQQ April 17th puts. These are at the 495 strike with a $20 million premium tag on them. Big money is hedging against tech weakness as the Nasdaq is continuing to struggle. And the dark pool data shows a shift. With SPY, we had $532 million in total volume with $417 million in puts. QQQ, we had $215 million in total volume with $162 million of that laying in puts. And then the translation here, big money is definitely playing defense. So typically following the big money is always a good play, fellas and ladies and gentlemen. But call buyers, where's the bullish money at though? Because, we need a little bit of balance in this market. So even if in the sell-off, there are some areas of strength. NVIDIA, we have calls that are coming in at the 120 strike for a June 2025 expiration date. We had over 302 million in premiums spent. Despite the tech pullback, some funds are doubling down on NVIDIA as long-term AI potential here. So that might have to tell you something there, folks. And Tesla is another one with the $300 calls with a June expiration date. We had $76 million in premiums. Tesla's been hammered lately, getting beat down lately like an NFL wife. But some traders are betting on a reversal here. Now, what is our key takeaways from this options market last week? Institutions are hedging hard, wicked hard, hard with puts on SPY and QQQ. So we're going to expect some more volatility there. Tech is still a battlefield. NVIDIA and Tesla calls show some bullish plays, but overall options flow is defensive. And dark pool data is confirming that big money isn't ready to buy the dip quite yet. Now our final thoughts, how do we play this? If inflation runs hot, short SPY and QQQ, the market will likely sell off further. We want to watch some bond yields. If they plunge, is a sign that traders expect a recession. And stay defensive with gold and value stocks. Now, if inflation comes in cooler than expected on the flip side, expect a bounce in tech and growth stocks. Nvidia, Tesla, and QQQ calls could see a pop, and SPY over 580 calls for a short-term trade. This week is all about inflation and tariffs. We'll be watching this data, tracking options flow, and looking for the next big move. And that's it for this week's market outlook. If you found this breakdown useful, make sure to like, subscribe, drop a comment with what you're watching in the market, and hit that bell notification so you never miss a Trades and Gains update. Now, some bonus on the weekly watch list here. SPY puts, March 21st. 580 strike is a defensive hedge. QQQ puts on April 17th expiration at the 495 strike. This is a Nasdaq correction play. We have Nvidia calls that are going to be June 2025 of the 120 strike. This is an AI growth bet for the long term. So those are hold and forget about them. And Tesla June 2025 $300 strike. It's a high risk, high reward play. So play smart. Trade smart, and let's make this week count. I'll see you guys in the next episode. Love you all. Have a great night.